with regard to pensions, it's a massively complicated topic. Again, just touching on the no one-to-one advice, more than happy to go into it in greater detail with attendees via an arranged one-to-one. But what I wanted to just talk about here was how I might be able to help somebody with either their personal pension arrangement or a final salary scheme work-based pension arrangement if they've had a diagnosis of cardiomyopathy. So if I may, I'd just like to do a little bit of a Doctor Who here and take us all back to pre-2015 and set out what the landscape looked like at that time for people who were about to take retirement. So they'd have had one of two types of pension. They'd have either had their own personal pension arrangement, which would have been something they'd have paid into all their working lives, and the markets would have done their thing and the pension would have gone up and down, and they hope that there's a lot more up than down. Or there would have been a final salary scheme pension, which is what they'd have had through their employer. So if I tackle the personal pension arrangement first, it's pre-2015, you've got to your retirement age, you have a look at what's in your fund, and we'll use that magical £100,000 again. So the fund's done reasonably well for you over all the years. It's worth £100,000. You've had your pension with, say, Aviva or Zurich or Royal London, whoever it's been with. What would you do? Your options at that time were extremely limited. You would be able to take 25% of your fund as tax-free cash. So in this hypothetical case, £25,000. You can do without, of course, whatever you like. You can invest it elsewhere, save it, spend it, do whatever you like. And you're then left with £75,000. Now, for 90% of people at that time, they will buy an annuity. An annuity was a guaranteed income for life. So again, they may well have thought, oh, well, I've been with Aviva all these years, or Zurich or Royal London. It's done quite well. They're offering me an annuity, this income for life. Let's see what they'll give me. So you ring them up and you say, okay, well, as you can see, I've got £75,000 left in my fund. How much will you give me for the rest of my life? And they'll give you a figure. And then they'll almost certainly would have had a bit more of a discussion with you. And they'd say, well, are you married? Yep, I am. Okay, well, in the event of your death, would you like your surviving spouse to have continued to have some of your pension? Oh, yeah, good idea. I'll have that. Yep, fine. Okay, well, we can put that in. Would you like your pension to increase each year so you've got a bit of protection against inflation? Oh, yeah, no, that's another great idea. Yep, please include that. Okay, now, if you were to retire on the Monday and got hit by a bus on the Tuesday, would you like a guaranteed period so that you'd know your surviving spouse could get the full pension for, say, 5 years from when you retire in case something happens to you? Yep, that's another good idea. Thank you very much. Yeah, I'd like all of those. Well, we will refer to those as bells and whistles in the financial services industry. And they're obviously great to have and very sensible to put in play in most circumstances. I mean, if you were a single person on your own, you're not going to need any of that, certainly not the spousal part of it. But for the majority of people, they would say, yeah, I'd like all those bells and whistles, please. So where you would have originally started off receiving, let's say, £400 a month, because you've added in these extra bells and whistles, that drops down with every bell and whistle until you may actually be getting £280 a month. They then take your £75,000, Mr. Aviva or Mr. Royal London, whoever you've put bought the annuity from, and you know that you've got that income for the rest of your life. If you predecease your spouse, she will then have an income for the rest of her life or his life. And when the spouse dies, that's the end of it. If there was anything left in the fund, it will go to Mr. Aviva or Mr. Zurich. Now, George Osborne decided in 2015 that it was a bit unfair to make it so inflexible for people who'd worked hard all their lives to save money in their personal pension, It was a bit unfair to expect them that they were going to be so restricted in how they could access their pension. Because for the majority of people, their best retirement years, health-wise, are going to be when they first retire. And that's quite likely when they're going to want most of their money coming through. So what George Osborne's pension freedoms actually did was give the choice, give the flexibility to the person who had that pension. So you could still take your 25,000 tax-free cash, but with the balance, with the 75,000, you didn't have to buy an annuity, this income for life. You may indeed decide that I'm going to use that 75,000 and I'm going to use more of it now in the early years. I want to go abroad with my wife. I want to visit Australia. I want to have the new kitchen. I want to get a camper van, and I'm going to use my pension monies for that. I'm going to do it wisely. I'll have my state pension perhaps kicking in 5 years' time, so I won't need to take so much from my personal pension. So George Osborne gave all of this freedom to people. And the real stark statistic of how well this has worked is that pre-2015, 90% of people bought an annuity with their pension fund. Now it's 10% of people buy an annuity because they prefer the flexibility of the new arrangement under the pension freedoms. So that's where we're at with personal pensions. When we then jump into the other camp and consider final salary schemes, with that, you're not actually building up a money pot for yourself. What you're actually doing is accruing a benefit. So every year that you work for your company, you accrue another 1 year of service. And if we again take a hypothetical situation, let's say Sandra's worked at this company all her working life. She's been there for 40 years. When she's finished, her salary is £50,000. Now, the accrual rate that the company's pension administrators would use would be, usually it would be, say, a 1/80th or a 1/60th. We're going to say it's a 1/80th scheme. So every year that goes by, she gets another 1/80th banked into her scheme. So after 40 years, hey presto, she's got 40 lots of 80ths. So that means she's got 50% of her final salary as her pension. So with a final salary of, let's say, 50,000 a year, she's going to have £25,000 as her pension from that scheme going forward. Now, final salary schemes have always been regarded as the gold standard in respect of pensions because you're not exposed to market risks as you are with your personal pension. They will automatically increase each year because of the effects of inflation. They will also provide spousal benefit upon your death. So, as I say, a number of advantages. And indeed, the Financial Conduct Authority, our regulators, always strongly state that any pension advisor must start from a position whereby it's not going to be in the interests of that particular pension member to transfer away from their final salary scheme to a personal salary scheme. So you would quite rightly say, well, why are you talking about it then, Bill? What, they're saying that it's not in their best interest. That's for the majority of cases. Indeed, it's not. However, again, when you factor in the cardiomyopathy, pension actuaries, and they're all slide rules and graphs and spreadsheets, they don't live in our sort of world, and they will automatically say, well, your life expectancy when you've got a serious condition isn't as good as somebody who's not got that serious condition. I mean, that's sort of fairly simplistic common sense that they would apply to it. So if you do have a serious condition, it doesn't just have to be cardiomyopathy, it could be anything, then there's a lot more justification in considering moving from the final salary scheme to a personal salary, to a personal pension arrangement. Because whilst they're great final salary schemes, they are especially restrictive. So, for example, if you've got one, you start your pension, you pass away, you've got a spouse, your spouse continues to benefit from your pension until your spouse passes away. That's then the end of it. A little bit like with the old personal pension pre-2015. However, if you've no longer got the final salary scheme because you have transferred to a personal pension arrangement, whatever's left in your pension pot can actually be left to your children. Indeed, it could even be legacy planning. It depends what else you've got available to leave your kids, you know. But what I'm saying is it's not the end of the fund. So by transferring it to a personal pension arrangement, you do get the benefits of being able to take as much as you want when you want. Obviously, you run the risk that you could run out of money, so you have to apply a little bit of sense here. And I would like to think you continue to seek financial advice around this, but it gives you the same flexibility then that other people have been enjoying within their personal pension arrangements. And as I say, when you've got a serious condition, there's very good justification to move it. It's not a decision that's done easily nor lightly, and you do need to have professional pension advice for this in order to do it. With a company that I'm a wealth partner at, we do indeed have internal pension transfer specialists. So if anybody has a final salary scheme pension and they like the sound of what I'm talking about, do contact me. I can get a few more details and we'll see if it's going to be in their best interest to actually move it to a personal pension arrangement. As I say, to gain from the death benefits, the greater flexibility, all things that you won't have within the realms of final salary scheme. So say there's quite a lot of information there, and I've just tried to keep it brief and simple. But it was really just to try and promote the thought process to anybody who's in either of those camps. As I say, I think I've got everything covered there on that. Let me just check my little notes. Yeah, I think I've covered everything that I want to try and cover with regards to the pension side of things, because we could literally be here all night, and I don't know how many of your panel or the attendees would be still with us by the end of it. I don't want anyone dropping off on me, so I'll leave it at that, and then see if there's any questions from the floor there, Jayne.
There are indeed, Bill. So one question that was submitted fairly late is still around insurance. So if we can just quickly,
sure.
But if you can answer that one, that'd be great. So a sibling of a child, a young person, had hypertrophic cardiomyopathy and recently died. The other son has hypertrophic cardiomyopathy, and the parent also has hypertrophic cardiomyopathy. The question is, can my son get extra life insurance with a first degree relative family history?
Yeah, well, what they would look at there is not only is it one family member, but there's sadly been one family member that's died from it as well. So it's increasing the risk level. I wouldn't rule it out. I would say, again, there'll be a number of questions I'd need to ask off the back of that initial inquiry before I'd be able to give a definitive, yes, I can help, or no, I can't. And I'm always sort of black and white with my clients, because there's nothing worse than them waiting around whilst failed applications go in, because sometimes it can take months to get an answer back from the insurer if they've got to go to doctor's surgeries for reports, etc. And as I say, part of my knowledge of the condition and knowledge of the insurance market means that I can tell reasonably accurately at an early stage whether or not we're in with a chance. And it might be, and I've done this with a number of clients, I'll say, well, no, we can't help just at the moment. We need to let 6 months or 12 months go by for whatever reason, then come back and then we can do it. And I've helped many people over the years in that way as well. So do contact me, but it does make it more difficult when you've had a family death and another family member, and that person has the condition themselves. But I'm not ruling it out.
Thank you, Bill. So in regard to pensions, who is in control of how much pension I can take every month? So they have no spouse, They want to know if they're considering whether their life expectancy might be shorter than they were expecting because of their diagnosis. So who's in control of how much pension they can take every month?
Okay, well, if they're in the final salary scheme, then it's the scheme administrators that will tell them from day one, this is going to be your pension going forward, and there's no flexibility about it. And if you've already commenced taking your pension from that scheme, you can't transfer it at a later date. If you're in a personal pension arrangement, the only thing stopping you taking as much money as you want is how much tax do you want to pay. And again, that comes down to having a discussion with your financial advisor. How much do you need? What do you need it for? Can we put it over 2 tax years, for example, so that we can try and keep the tax as low as possible? But so on paper, you could take everything in your personal pension in one go if you wanted. So with that theoretical 100,000, you take your 25,000 tax free. You can take the balance, 75,000, but if you took it straight away in one lump sum, a huge amount of it is going to be hit with tax, a chunk of it at 40% tax. So it's about planning it, and if you could break it down over 2 tax years, knowing how much other income that you've got in, all of that needs to be assessed and calculated to advise the best and most tax efficient way to take it out of your pension. But yeah, personal pension arrangement, you're in charge, but you want to do it as tax efficiently as possible. Final salary scheme, you've got no say in it. You just continue to get your 25,000 a year, as was in the case that I demonstrated, which will go up each year with inflation, but you can't alter the payments that you get.
Thank you, Bill. Okay. So the person that's asked the question is in their late 40s. They have no children. They're diagnosed with a dilated cardiomyopathy. They have 6 company pensions worth around 80,000. They're looking to retire early at the age of 57 and feel they've got 9 years to work remaining. They're thinking at that point they'll have 100,000 in the pot. Would that potentially be enough to retire early on?
Well, they're going to be looking at state pension then kicking in when they get to 67. So in theory, they've got 10 years to remain completely self-sufficient funds-wise. It really depends on how much they need each month to pay their bills and lead the kind of lifestyle that they would like to lead. So as with a number of the life insurance questions, there are lots more questions off the back of that. And again, I'd be happy to look at that with that particular client if they want to get in touch with me, because you would just basically do a little bit of cash flow modeling, for example. You might then want to say, right, how much do you think you're going to need? Will your mortgage be paid off? Will you have any other debts that need doing? What do you want to do when you first retire? So you can see how the questions start to cascade, and then how much information you need to gather to be able to give that person a suitable answer. But that's all part of the process of engaging with a financial advisor.
Thank you, Bill.
Okay.
So another question was around a frozen work pension, which is an NHS pension. They've also got a personal pension. Would it be advisable to move an NHS pension into their personal pension plan?
Short answer is no. And the second part of that, I don't believe civil service plans can be moved from the final salary or the NHS wrapper that they're in, but you certainly wouldn't want to move that. It's a very generous scheme, dependent on the scheme that they're in. There's the 1995 scheme and there's the 2015 scheme. A lot of people of sort of, say, aged 35, 40 plus would be in the original 1995 scheme. They are migrating them across slowly so that their last few years of service are in the 2015 scheme, which is less generous than the 1995 one. But on the whole, the NHS scheme is a really generous one. It would need to have some detailed documentation and analysis to be able to give that person a specific answer. But from my knowledge, NHS schemes, you wouldn't be able to move that across into the personal pension arrangement.
Thank you, Bill.
Okay.
So I think we've done that one. Yeah. So is it possible to take early retirement due to ill health with a diagnosis of arrhythmogenic right ventricular cardiomyopathy. So can they take an early retirement?
Yeah, well, again, it depends which camp they're in. Are they in the personal pension arrangement? Are they in the final salary scheme arrangement? Now, the administrators and trustees of the pension fund, if it is a final salary, they would be worth contacting to say, right, I've got this condition. Can I access my pension early because of it? They would come back and say, yes, you can. However, you're going to lose some of your pension because you're accessing it X number of years early. They would have their internal actuaries do all the calculations. And it might be, for example, that they would say, when you've reached age 63 with our scheme, you would have, all things being equal, if you'd have stayed with us, you would have been on £20,000 a year pension. Because you're going at 52, you're having 13 years early, so that pension level is going to decrease by X number of pounds. So it's not something that is a straightforward no, but sometimes what you would be giving up can be so considerable that you think, well, I'll just leave it, and you can revisit it the next year and the next year, and hopefully then it will go up slightly more. So yes, you can. In terms of your personal pension arrangement, again, 55 is the current age that you can access your pension. If you can demonstrate severe ill health and consequently reduced life expectancy, then there's a very good chance that you'll be able to access your pension. But it is a very complex area, and there's a number of additional questions that would need to be answered. So short answer, yes, but depending is what I'd say to caveat that.
Thank you, Bill. So somebody's got a Scottish NHS pension and they're being offered the opportunity to change to a 2015 version of the pension. Is this financially advantageous?
Not normally, no. The later schemes are not as generous as the first ones. What they've tended to do, I can't speak for the Scottish scheme because I've not had any dealings with it, but certainly for England and Wales, they've just moved them across. They've got to the older members of the scheme later, and they're moving them across from the 1995 scheme to the 2015 scheme because it is slightly less generous. It's saving them money. So if you can remain in the 1995 scheme, I'm assuming it will be the same in Scotland, for as long as possible, then do so. They will offer to move you across. As I say, for all the cases that I've experienced to date within the NHS ones, the earlier scheme is the better scheme. Okay.
Thank you, Bill.
I mean, sorry, having said that, you may not have any options, and they may be saying, well, that's tough, you're moving to this anyway, but all of the benefits that you've built up before you move across will stay in the old scheme. So you'll still have that better benefit package than you will get with the later scheme. It's just the going forward, your benefits will accrue under the 2015 scheme rather than the 1995 scheme.
Thank you. A question around percentage-wise, is there a difference between annuities and enhanced annuities?
Indeed, there is. Yes, I'm glad that person raised that. Thank you. I'd forgotten to mention that. So an enhanced annuity is available to you. Obviously, if you're looking to go down the annuities route, and as I've already stressed, there's fewer and fewer people that are doing that. But if you have it doesn't even need to be a serious condition. It could be that you're just a smoker. There's a whole plethora of additional medical facts and information that the pension company would ask you. The more that boxes that you can tick, the more enhanced or greater the value of the pension that you can get, because it's almost like the reverse of a life insurance, if you like. The actuaries for the annuity provider are saying, right, well, this client has ticked, they smoke, they've got diabetes, they've got high BMI, they've got cardiomyopathy. Each one is lessening the expected life expectancy for that person, so they can pay out slightly more. So that's where the enhanced version comes into it. And an enhanced annuity will pay. It depends on the number of conditions that are ticked. The pension provider that you've gone to request the annuity from. So again, as with all of this evening, I'm sorry, I can't be specific without a lot more information. But yeah, an enhanced annuity is going to give you a better payment than the standard annuity for the reasons that I've just mentioned. But exactly how much depends on how big the fund is, what the conditions are that you've ticked, and the company that you're going to.
Thank you. So in regard to legacy work pensions, if you cannot add any additional premiums to your pension pots, is it possible to amalgamate them with different providers to reduce the fees deducted each year for each pension pot? And the note is that they're not working at the moment.
Yeah, well, I mean, you can certainly look to consolidate all of your pensions into one. I mean, you've then only got one pension pot to monitor. But again, if there's been any pensions that have been accrued within a final salary scheme wrapper, you will need to get specialist pension advice. The golden rule is if the value of your final salary scheme is £30,000 or more, I don't mean the pension payable, I mean the value of your scheme, and the scheme actuaries can tell you what it's worth. So you would just go to them and say, can you tell me what the transfer value is of my final salary scheme? They may not be able to tell you over the phone, but they'll invariably come back to you fairly soon and say, right, it's worth X number of pounds. Any final salary scheme that you've been paying into for more than a couple of years, to be perfectly honest with you, is likely to be worth more than 30,000. If it's more than 30,000, you need to get specialist advice, and then they will look at what you're trying to do. Because as your attendee has outlined there, they've got a number of pots all over the place. It will be very sensible to have a proper pension review done on that. Move what can be moved to just one. Again, they've referenced charges. Very, very sensible to look at the charges, as well as perhaps the past performance. What is the financial acumen of the pension provider themselves? How financially strong are they, etc. So all of that can be done with the financial advisor. And I would suggest for that client, it'd be very worthwhile having a review done on the various pots and having a strategy put forward in place so that they can follow that through. But yeah, consolidating them all in one place, if it's possible to do so without any financial penalties, would make a good deal of sense. It's just one pot to monitor, one lot of charges coming out, and makes life a lot easier for everyone concerned.
Thank you, Bill.
Okay.
So this is an LGPS, which is a local government pension scheme. Yeah. Can this be transferred to a pension pot or not?
Unlikely, given that it's the civil servant wrapper. Worth exploring. It would just be a simple phone call to HR, who are in charge of that scheme, to ask, inquire, is it possible? They would soon be told yes or no. And again, sorry to be so sort of unspecific about this, but like with life insurance, with final salary schemes, scheme rules rule. So they've all got slightly different ways of administrating and the way that the plans are set up. So always start with HR with that question. If they come back to you and say, yes, you can, your next question should be, can you give me a transfer value, or come back to me with a transfer value? If it's 30,000 or more, then get in touch with a pension transfer specialist and have a look at it. As I say, the starting position is it's not going to be in your interest. However, you've got a cardiomyopathy. You want the flexibility of a personal pension arrangement and the death benefits, for example. So there will be a strong case for a recommendation being made that, yes, to actually move it.
Thank you, Bill. And your previous answer to the question, the person said, thank you very much. That's the clearest explanation they have ever heard.
Oh, please hear it.
So that was the complicated one about all the amalgamation into different pots. Final question at the moment is, can a heart transplant affect a pension?
Affect a pension? Is that pension already in payment, do we know, or is that person waiting to take their pension?
I don't know, but I think maybe if they could just type that into the chat box, the person that asked that question, if they can just not yet. Not yet. Thank you for typing that.
Yeah. Well, again, if they were seeking an enhanced annuity, yes, of course it would. It would mean that if they went down the annuity route, then they will get a considerably higher level of pension offered to them by the pension provider. In respect of not going down the annuity route, and as I pointed out, only 10% of personal pensions now end up with annuities. In respect of not going down that, they would have all of the access to the fund as and when they wanted it. So say there were a number of caveats to that. Obviously, if you exhaust the fund early, you could find that you've run out of pension funds. But like I did say, I'd like to think that once you've engaged with a financial advisor, you continue to do so that you're reminded that, hang on, you're taking far too much out of this pension at the moment. Why do you need it? It's different if it's, something that you've always wanted to do, and then the next 2 or 3 years you're going to be taking just enough for fish and chips, if you like, so you're going to be reducing it. So there's, but this is about tailoring advice to suit the client's needs. So yes, he could certainly get more on an enhanced annuity. It won't have any effect on a final salary scheme. He will be getting what they're telling him he's getting. The fact that he's had a heart transplant is irrelevant unless he's looking to access it early because he's unable to work. And then they'll do a deduction and come back to him.